Hi, welcome back to the Concierge Corner. My name is Don Tiegs and I am your insurance concierge. And today we're going to talk about one of the most common frustrations for high income clients, and that's their ability to create tax free incomes. Now, there are several strategies to create tax free income, but before we get into that, I want you to do a quick mental scan of your own book of business. So think of the top 10 to 20 clients who earn strong six figure incomes. They're probably already maxing out their 401k. And they might be worried about what future tax rates might look like in retirement. So now ask yourself this: if tax rates do go up, how much of their retirement is really exposed to those future tax laws? So just hold on to that thought in your mind as we go along here. So let's start with one tax-free strategy, and that's a Roth IRA. A Roth IRA is a tax it now and tax it never later strategy, right? Clients contribute after tax dollars, and the money grows tax free, and qualified withdrawals in retirement are also tax free. So in 2026, the Roth IRA contribution limit is $7,500 per year, with an additional $1,100 catch up contributions for those of us who are age 50 and older. So that brings our total up to $8,600 per year. However, these limits phase out at higher incomes. So those making over $168,000 for single filers or $252,000 for joint filers, they no longer have the ability to contribute to a Roth. So you see, your best, most profitable clients are often the least able to use Roth IRAs. They're just simply making too much money. And, they might also be frustrated that the tax system is basically telling them, I'm sorry, you did too well. No more tax free bucket for you. So that frustration is the opening for this entire conversation. So when the IRS effectively closes the Roth door, what are your clients' options? I mean, of course, there are, backdoor Roths and mega backdoor Roths, but those strategies come with complexity, potential legislative risk, and they still might not be available or even practical for every client. So the second option here is a properly designed cash value life insurance policy. Now, a properly structured cash value life insurance policy can function as a Roth supplement or even a Roth alternative for the right client. Now, I'm not saying that life insurance is the same as a Roth, because it's not. A Roth is a retirement account, and the insurance policy is just that. It's an insurance contract. But for high income clients who need permanent death benefit and who also want another tax advantaged bucket, this can be a powerful strategy. So let's compare both strategies here now. First, the similarities. Both are funded with after tax dollars. Roth contributions are made with after tax money. Life insurance premiums are also paid with after tax money. Both can offer tax advantage growth. In a Roth, growth is tax free if the rules are followed. In cash value life insurance, the cash value grows tax deferred, and when structured properly, clients can access the cash value through policy loans, and those loans can be income tax free under the current law. Both avoid required minimum distributions during the client's lifetime, and both provide tax advantaged wealth transfer. So now you see, a Roth IRA generally allows beneficiaries to receive income tax free distributions, although large estates can still face estate taxes, right? Life insurance death benefits is generally income tax free to beneficiaries and can be used for estate liquidity or legacy. And depending on how it's all structured, a tax-free death benefit, right? So in the client's mind, you are shaping this category as ways to build money in a tax-favored bucket that the IRS cannot easily touch later. So now here's where you really build credibility with your clients. And you build that credibility by clearly explaining the differences and the trade-offs between the two. First, with the structure and simplicity, a Roth IRA is a simple investment account, usually low cost. And the client chooses, mutual funds, ETFs, or some model portfolio. There's no medical underwriting, and if their income is low enough to qualify, they're able to contribute. Cash value life insurance, whether it's whole life or indexed universal life, is an insurance contract first and accumulation vehicle second. Now, there are policy charges, costs of insurance, administrative fees, and sometimes surrender charges. And the client has to qualify both medically and financially. And the policy must be designed carefully to minimize those costs and maximize the cash value potential. Second difference is the limits and flexibility. A Roth IRA has strict annual contribution limits and income phase-outs. There are penalties for non-qualified withdrawals before age 59 and a half. Cash value life insurance does not have Roth-style income limits on who can fund it. And there's no formal IRS contribution limit like a Roth, but you have to stay within the MEC limits and follow carrier guidelines. Access to cash values via policy loans and withdrawals can often be done before age 59 and a half without early withdrawal penalty that applies to like Roth IRAs. Third, its purpose. A Roth IRA's primary purpose is accumulation for retirement income, with the secondary benefit as a tax-efficient asset to inherit. Life insurance primary purpose is death benefit protection. The secondary purpose is tax-advantaged cash value that can supplement retirement if the policy is funded and managed over time. I mean, you don't buy a life insurance policy as a retirement account. You buy life insurance because you want the protection. And if structured the right way, it can also create a very attractive tax-favored bucket for later. So let's walk through a scenario here, a high-level scenario. And these numbers are purely hypothetical and for educational purposes only. Actual results depend on product choice, performance, costs, and underwriting, right? So let's meet Mike and Robin. They're both 45 years old. They're married. They have a household income around $240,000 a year, right? They're maxing out the 401ks at work. They are over the income threshold for direct Roth IRA contributions. They do say that they need additional life insurance coverage and want income replacement and legacy. In this case, they would like to save another $10,000 per year for retirement, and their CPA says they've been shut out of the Roth. So what else can they do that's tax efficient? Well, here's a possible strategy. You design a cash value life insurance policy with minimum death benefit needed to meet their protection goals and structure it to maximize the cash value growth potential within the policy's guidelines. Let's say they commit $10,000 per year for 20 years, roughly age 45 to age 65, for a total of $200,000 in premium. Now, assuming they fund as planned and the policy performs as illustrated, in retirement, they may be able to begin taking policy loans to create a supplemental tax-favored income stream. For example, something in the neighborhood of low to mid 5 figures per year for a set period of time, while still retaining some remaining death benefit. If they never need the income, the full death benefit passes on income tax-free to the heirs. If they do need the income, the death benefit is reduced, but they've effectively shifted a portion of their wealth into a more tax-advantaged structure. Again, this is not a guarantee. This is simply an illustration of how the concept works. Your job as the agent is to determine whether this client is a good fit financially, medically, and behaviorally for the strategy. So, where does this strategy fit within your practice? Well, this is where it makes sense. High income W 2 earners who are maximizing qualified plans, who are over or close to Roth income limits, and who have a real need for permanent death benefit. Clients who are concerned about higher future tax rates, and clients who are looking for more money in the tax advantage bucket. And, clients who are comfortable with long-term commitments of 10, 15, 20 years or more. So basically what you're doing, you're inviting those folks into a better structure for money that they're willing to save. This isn't a conversation you have often. So if you don't have that conversation often, you don't have to be the life insurance expert overnight. That's why the concierge model exists. I can help you identify which clients are good candidates. I can help you work with carriers to design compliant, efficient policies. I can help review illustrations so you're not overpromising income. And I can give you client-friendly language that you can use in meetings, webinars, review appointments. So you keep the relationship, you stay the hero in the client story. We simply stand behind you with the technical and strategic support. So as you think about your top clients this week, ask yourself, who is earning too much money for a Roth? Who has already maxed out the 401k but still wants to save more? Who is worried about future tax rates and looking for creative, compliant solutions? Those are the people who may be perfect candidates for using life insurance as a Roth supplement or a Roth alternative. If you'd like help growing and diversifying your practice with strategies like this, reach out to me directly at 763-265-3297. Together, we'll bring clarity, confidence, and concierge to your clients' retirement income plans, so you're not just selling policies, you're helping them build smarter, more tax-efficient futures. Thank you for watching Concierge Corner. Again, you can reach me at 763-265-3297. Have an amazing day.